You know, you see it every single time the market catches a cold.
Oh, yeah, like clockwork.
Right. A headline breaks, maybe it's a sudden spike in inflation or maybe some geopolitical flare-up, and immediately an entire generation of traders just opens up the exact same tired playbook.
They flip right to page 42.
Exactly. They look at the historical charts
Mm.
and they deploy the capital. I mean, the textbook says you buy gold when things get scary, right?
That's the conditional wisdom, yeah.
And it says you buy commodities when inflation runs hot. And while it tells you that, well, the U.S. dollar might catch a temporary bid during a panic, you ultimately want to fade that strength because, it's going to revert to the mean.
Right, the old mean reversion trade.
Yeah. And we have all internalized these rules. But if you look at the actual market reality in 2026, relying on that legacy playbook is just quietly blowing up portfolios left and right.
Completely shredding them. It's brutal to watch.
It is, because the structural foundation beneath those old rules has just completely fractured. And that's what we are getting into today.
I'm glad we are, because people are really struggling with this right now.
Yeah, the goal of today's deep dive is to deconstruct this broken playbook for you. We're going to explore why the whole idea of a safe haven is actually just an illusion,
A total illusion.
and why assets are acting so incredibly strangely right now.
Huh?
So tick this off. I'll be coming at this trying to translate some of these complex ideas, and I've got a macro strategist here to really diagnose the underlying plumbing of the market.
That's the plan. Let's dig into the plumbing.
So the central thesis we are working with today is this. A safe haven is not an inherent property of an asset. It's conditional. It is completely dependent on macro structure, on liquidity, and policy alignment.
Right. And I think to start, we have to recognize that the market just fundamentally craves binary outcomes.
What do you mean by binary?
I mean, we want the comfort of looking back at, say, 40 years of data and concluding that if A happens, B is the guaranteed result.
Like if inflation rises, commodities rise.
Exactly. Or if risk assets sell off, gold automatically acts as a parachute. But market participants right now, they are treating temporary market weather as if it were an immutable law of physics.
Oh, wow. Okay, wait.
Yeah, they're confusing an outcome that occurred under very specific historical conditions with, like, an inherent property of the asset itself.
Wait, let's unpack this for a second.
Right.
Are you saying that decades of data showing gold reacting to war or, inflation is just a coincidence?
Mole.
Like, how can so many smart people have the why completely wrong?
The historical charts aren't fake. I mean, they are perfectly accurate. Gold did rally during crises for decades. The error lies entirely in how we attribute causality.
Okay, causality. Walk me through that.
Think about the way the human brain processes complex events. We are sort of hardwired to seek narrative simplicity.
Sure. We like easy stories.
Right. So when a massive geopolitical shock hits or some major financial institution collapses, that is a vivid, terrifying front-page headline.
It's all anyone is talking about.
Exactly. And simultaneously, you might look at your terminal and see gold rocketing higher. So the intuitive, emotionally satisfying conclusion is just to draw a direct line between the two.
Yeah. So we say the crisis caused gold to rally because people were scared and they bought a hard asset.
Yes, it's narrative economics. The story makes intuitive sense, so we just stop looking for deeper mechanical reasons. We slap a label on gold, call it the ultimate fear gauge, and call it a day.
But by stopping there, what are we missing? What's the invisible machinery we're ignoring?
We are ignoring the monetary regime. Look at the last few decades leading up to our current environment. What was the standard operating procedure for central banks the moment a crisis hit?
Well, they printed money. They flooded the system with liquidity.
Exactly. They slashed interest rates to zero. They engaged in massive quantitative easing, buying up bonds to suppress yields across the entire curve.
So you're saying the crisis was merely the trigger?
Yes. The crisis forced the central bank to alter the plumbing. That central bank intervention is what fundamentally altered the cost of capital.
Oh, man. So they created this environment of expanding liquidity and plunging real interest rates.
Right. And that specific monetary environment is what acted as rocket fuel for gold. But because monetary plumbing, the expansion of the M2 money supply, the mechanics of open market operations, that stuff is abstract.
It's boring to the average person.
Yeah, it's frankly boring. While a war or a banking collapse is visceral, So the broader market misattributed the rally. They assigned the causality to the headline rather than the liquidity injection.
That is wild. We basically confused the symptom with the disease. Or
Hmm.
actually, we've talked about this analogy before. It's like the weather and the umbrella.
Oh, I love that analogy. Go ahead.
It's like carrying an umbrella every single time you see people wearing rain boots. You assume the umbrella is what keeps you dry, but you never actually check if it's raining.
Right, you're just following the visual cue.
Yeah. The umbrella only provides safety if water is literally falling from the sky. If you open it during a hurricane, it gets ripped out of your hands. If you open it in a heat wave, you just look ridiculous.
That is exactly what's happening. The financial weather in 2026 has violently shifted. Central banks are no longer reflexively dropping rates to zero the second a scary headline crosses the tape.
Because they can't, right? They're boxed in.
Exactly. The underlying monetary regime has changed. Inflationary pressures and these huge structural shifts in global supply chains have forced central banks into a corner.
So they can't just print their way out of a localized panic anymore.
No, because if they do, they risk broader currency debasement and deeply entrenched inflation. So market participants who are blindly deploying the old playbook, they are walking into a Category 5 hurricane holding that same fragile umbrella,
And they are completely bewildered as to why their portfolio is getting shredded.
completely caught off guard.
Which brings us to, honestly, the most visible casualty of this paradigm shift.
Yeah.
We have to talk about gold.
Oh, absolutely. Gold is the poster child for this confusion right now.
Because if there is one asset that is driving traditional macro investors absolutely insane in 2026, it is gold. It feels entirely fragmented.
It really does. It's schizo right now.
Like, one week, the market gets hit with a terrifying systemic shock, and gold surges. But then the next week, an equally bad headline hits, and gold just completely ignores it. Or worse, it aggressively sells off.
Yeah, it just craters when you least expect it.
Right. It catches a bid on an inflation print, and then a month later, when inflation is mathematically proven to be accelerating, gold drops.
I know. If you are operating on the assumption that gold is this timeless store of value, its behavior right now feels completely broken.
So why isn't it broken? What are they missing?
Well, anyone relying on the legacy framework is going to view this price action as irrational. But once you strip away the mythology and that emotional attachment to gold as a protector, the mechanics make perfect sense.
Okay, break the mechanics down for me.
Gold is a highly sensitive instrument, but it is responding to a very specific set of primary drivers that are currently in profound conflict with one another. To understand this, we have to look ruthlessly at what gold actually is.
And what it is not.
Exactly. What is gold, really? We all know it yields absolutely nothing.
Right. It's just a shiny rock sitting in a vault in London or New York.
It doesn't pay a quarterly dividend. It doesn't execute share buybacks. It doesn't generate cash flow. So there's always an opportunity cost to holding it.
But wait, in previous decades, that zero yield was totally fine, right?
Yeah, it was a perfectly acceptable proposition because the alternatives were terrible. When central banks had rates pinned at zero and inflation was running at 2%, your real return on cash was negative.
Ah, the real return. Let's make sure everyone is clear on that math.
The math on the opportunity cost has fundamentally inverted today. The real interest rate is the crucial metric here. It is the nominal yield you receive from a risk-free instrument like a short-duration U.S. Treasury bill minus the prevailing rate of inflation.
Right. So if the government pays you 1%, but inflation erodes your purchasing power by 3%?
Your real return is negative 2%. And for a very long time, that equation resulted in a negative number. In that specific macro environment, holding a non-yielding asset like gold is incredibly attractive.
Because zero is mathematically superior to -2.
Exactly. The environment was actively penalizing people for holding cash or sovereign bonds. It pushed capital out the risk curve and into hard assets.
But in 2026, the central banks have fought back. Nominal rates are elevated. So now, holding gold feels a bit like, well, think about it like real estate.
Oh, I like where this is going.
It's like owning a beautiful, pristine, completely empty plot of land in the middle of Manhattan.
Right.
It holds value, sure, because they aren't making any more land in Manhattan. But you are missing out on the massive, guaranteed rent you could be collecting if you built a high-yield apartment building on it.
That is the perfect way to look at it.
And the higher the rent goes everywhere else in the city, the more painfully expensive it feels to just sit on that empty dirt and watch everyone else collect monthly cash flows.
The penalty for holding non-yielding assets in a high real rate environment is immense. Institutional portfolio managers, they don't operate on sentiment,
Yeah.
They operate on spread and yield.
They have to. They have bosses and benchmarks.
Right. Imagine a sovereign wealth fund or a massive pension system with billions of dollars to allocate. They look at gold, which guarantees them nothing and subjects them to price volatility.
And then they look at the alternatives.
Yeah, they look at a short-term U.S. Treasury bill offering a robust, positive real return. They are being offered a risk-free rate that not only compensates them for inflation, but actively grows their purchasing power.
So they dump the empty lot and buy the apartment building.
They are structurally mandated to seek that real return. Every single day, an institution holds gold. Instead of a positively yielding risk-free asset, they are bleeding potential alpha.
Wow.
That massive opportunity cost acts as a gravitational force pulling gold down. So going back to the confusion surrounding gold's behavior in 2026.
Right, why it drops when inflation goes up.
Yeah, when inflation accelerates, the legacy playbook screams, buy gold. But the institutional market understands that accelerating inflation forces the central bank to hold nominal rates higher for longer.
Ah. So the inflation actually triggers a chain reaction that hurts gold.
That is the structural irony. The inflation print might cause a knee-jerk algorithm-driven spike in gold for about 10 minutes. But then the bond market reprices.
The bond traders see the Fed getting hawkish.
Exactly. Treasury yield spikes as traders realize the central bank will have to maintain restrictive policy. Real yields rise, the opportunity cost of holding gold increases, and institutional capital rotates out of the metal and into yielding instruments.
So it looks like a perfectly bullish catalyst on the surface, high inflation, ultimately crushes the asset because of the mechanical reaction in the rates market.
You nailed it. And it isn't just real yields acting as gravity either. Gold is caught in this brutal tug of war right now.
What's on the other side of the rope?
Well, on one side, you have the traditional forces that pull gold higher. We have immense geopolitical instability, fractured supply chains, and undeniable inflation concerns.
Right, all the scary stuff.
Yeah, those forces are desperately trying to attract capital flows from investors seeking a classic store of value. But on the other side of the rope, you have tightening global liquidity and a structurally dominant U.S. dollar.
And that's a huge problem for gold because of how it's priced, right?
Exactly. Because gold is globally priced and traded in U.S. dollars, there is a mechanical inverse relationship. As the U.S. dollar strengthens, it simply requires fewer dollars to purchase an ounce of gold.
So it puts a ceiling on it.
It places an artificial ceiling on gold's price appreciation in dollar terms, yes.
Okay, so let me get this straight. Even if I am, say, a European investor, and I am terrified of a regional conflict, I aggressively buy gold to protect my wealth.
Very common reaction.
But if the U.S. dollar is surging across foreign exchange boards at the exact same time, my gold position might just trade sideways or even bleed out.
Yes. The crossfire of these competing macro forces is what makes the asset look broken. Fear pushes it up, but rising real yields and a wrecking ball dollar push it down.
So you need all the stars to align for gold to really run.
Precisely. Without a synchronized macro regime where all forces align like we saw in the aftermath of 2008 when fear was high and rates were zero and the dollar was weakening, the price action just becomes chaotic.
You really cannot trade gold effectively without first diagnosing the strength of its main competitor for global capital.
You can't. And that competitor is the U.S. dollar.
Which means we need to spend some serious time dissecting the U.S. dollar. Because this is where the concept of a safe haven transitions from an illusion into a structural reality.
It really is the foundation of everything.
We tend to view the dollar as just another ticker symbol on a Bloomberg terminal. You have your ASD, you have USD/JPY, you have gold. We think they're all just competing assets.
That is a dangerous underestimation of the dollar's actual role.
Right. So how should we be thinking about it?
Treating the U.S. dollar as merely a participant in the global financial system is like treating the ocean as just another type of fish.
Whoa. The ocean, not a fish.
The dollar is the medium in which everything else swims. It is the underlying architecture, the plumbing, and the ultimate clearing mechanism for global trade and finance.
Okay, let's trace the actual plumbing then.
Yeah.
When a true financial crisis hits, and I don't mean just a bad earnings season, I mean a real systemic freeze.
Yeah.
What is the mechanical difference between holding a gold bar and holding a U.S. Treasury bill?
Night and day.
Why does the dollar behave so differently?
We have to look at the euro-dollar market and this colossal mountain of global dollar-denominated debt.
The euro-dollar market. Tell me more.
Trillions of dollars in liabilities issued by foreign governments, emerging market corporations, and massive European banks are denominated in U.S. dollars.
Even though they aren't in the U.S.
Right. These entities do not operate within the United States, yet they have borrowed in the U.S. currency.
But why do they do that? Like, why would a Brazilian corporation borrow in dollars instead of their own currency, the real?
Because the U.S. dollar market is the deepest, most liquid capital market on the planet. Historically, it offered lower interest rates and just much easier access to massive institutional capital.
Oh, so it was just cheaper and easier money.
Exactly. But borrowing in dollars creates a structural mismatch for them. The Brazilian corporation is earning its revenue in Brazilian reais, but it has to service its debt, pay the interest, and roll over the principal in U.S. dollars.
Okay, so the corporation is essentially constantly short the U.S. dollar. They always need to go out and acquire it.
They have a persistent structural short position. And in a benign economic environment, this is totally fine. The global economy is humming, trade is flowing, and dollars are relatively easy to acquire.
But then a shock happens.
Yes. When a systemic shock occurs, global credit markets freeze. Banks stop lending to one another because counterparty risk spikes. Liquidity just evaporates overnight.
And suddenly, that Brazilian corporation is in deep trouble.
Right. Suddenly, they cannot roll over their debt. They have to find actual, physical U.S. dollars to avoid defaulting.
And they can't pay their bondholders in gold.
They absolutely cannot, nor can hedge funds and institutional investors meet their margin calls in gold.
Right, margin calls. That's a huge part of the plumbing.
During a market crash, the value of the collateral that institutions use to borrow money plummets. When those collateral values drop, prime brokers issue margin calls, demanding immediate cash injections to cover the difference.
And prime brokers aren't taking shiny rocks.
No, those margin requirements must be settled in dollars.
So we have a situation where the demand for the dollar has absolutely nothing to do with market sentiment. No one is sitting there analyzing U.S. GDP growth or reading the Federal Reserve's minutes to decide if they, quote-unquote, like the dollar.
It is pure, unadulterated survival. The demand is force. Institutions are selling everything they own, equities, emerging market bonds, copper, and yes, gold, in a desperate scramble to raise U.S. dollars.
Just to stabilize their balance sheets and prevent insolvency.
Exactly. This creates a reflexive mechanical bid for the dollar that no other asset on Earth can replicate.
It's a forced liquidation cascade. And the dollar is literally the only asset that can plug the hole.
The only one.
This brings up one of the most elegant concepts in macroeconomics. The dollar smile. Because the dollar doesn't just benefit from fear, right? It has an unfair advantage on the other end of the spectrum, too.
But dollar smile is brilliant. Let's walk through it.
Let's start with the left side, which is exactly what we just described.
Right. So imagine a graph. The vertical axis represents the strength of the dollar. The left side of the smile curves sharply upward during periods of extreme global distress.
When the world is burning.
Yeah. As we just detailed, when the world economy is contracting, when panic sets in, and when credit freezes, the forced scramble for liquidity shoots the dollar's value straight up.
So it acts as the ultimate safe haven, not by choice, but by systemic necessity.
Systemic necessity, that's the perfect phrase.
So the left side of the smile is driven by panic and debt mechanics. But then we trace the curve down to the bottom and back up to the right side of the smile, and the right side curves upward just as sharply.
It does.
But the macro environment over there couldn't be more different.
Completely different. The right side represents a scenario where the U.S. economy is dominating. U.S. growth is significantly outpacing the rest of the world. Productivity is high.
Everything is booming.
Right. And because the economy is running hot, the Federal Reserve raises nominal interest rates to prevent overheating.
Which means the yield on U.S. assets becomes incredibly attractive globally.
Exactly. Capital flows are inherently mercenary.
Yeah.
They relentlessly seek the highest risk-adjusted return.
So if I'm in Europe,
if a European institutional investor is looking at zero-growth Europe on one hand and a booming U.S. economy offering a 5% risk-free rate on treasuries on the other, the decision is mechanical.
they sell euros, buy dollars, and park that capital in U.S. assets.
This massive inflow of foreign capital bids up the value of the dollar aggressively.
So the dollar strengthens violently when the world is ending. And NED, it strengthens violently when the U.S. economy is thriving. The structural deck is incredibly stacked.
The U.S. dollar effectively captures both ends of the macroeconomic distribution curve. It is the ultimate defensive asset during a crash, and it is the premier yield-generating asset during a U.S. outperformance cycle.
Wow. Okay, so when does the dollar actually weaken? What has to happen for the smile to dip into that trough in the middle?
The trough of the smile requires a very narrow, highly specific set of global conditions. You need synchronized global growth.
Synchronized, meaning everyone is doing well.
Right. The U.S. economy cannot be the only engine pulling the train. Europe, Asia, and emerging markets all must be experiencing robust, accelerating economic expansion.
And crucially, the Federal Reserve has to be accommodating, right?
Yeah.
They can't be hiking rates
Yeah,
aggressively.
you need a relatively dovish Federal Reserve, meaning U.S. yields are not siphoning capital away from the rest of the world.
A Goldilocks scenario.
In this Goldilocks environment, risk appetite just explodes. Investors feel incredibly confident. They realize they don't need the safety of the U.S. dollar, and they don't need the 5% yield of a treasury bill because they can make 15% investing in emerging market equities.
Or foreign infrastructure projects, right?
So they sell their dollars to buy foreign assets. Capital aggressively flows out of the U.S. and into the global periphery.
And that drops the dollar.
That is the only structural environment where the U.S. dollar enters a sustained, fundamental bear market.
But if you look at the landscape of 2026, synchronized global growth is entirely absent. The global economy is completely fractured.
Completely. Which means the default state of the system is a strong dollar. Unless everything is perfect everywhere, the dollar wants to go up.
That is a total paradigm shift for anyone who thinks currency markets are just a random coin toss based on daily news flow.
It changes everything. In a regime characterized by elevated interest rates and localized economic instability, holding dollars is not merely a defensive crouch. It is an actively profitable strategy.
Because you're getting paid to hold it.
You are being paid a premium yield to hold the most liquid, structurally necessary asset on the board. This dual engine of yield and structural demand is exactly why the dollar consistently cannibalizes gold's market share in environments where the legacy playbook insists gold should be outperforming.
Okay, so we have established the absolute supremacy of the dollar. And we know it reacts heavily to interest rates. High rates mean a strong right side of the smile.
Right.
But central banks don't raise interest rates in a vacuum. They are reacting to data. They are reacting to catalysts. And that brings us to the fourth major component of this deconstruction, oil.
Oil. Yes.
Because if there is one asset that forces a central bank's hand faster than anything else, it's energy.
Oil is perhaps the most misdiagnosed asset in modern portfolio construction.
Seriously, the traditional wisdom I was taught and what millions of retail investors execute every day is that oil is a defensive inflation hedge.
That's the myth.
The logic seems so straightforward, though. If inflation is rising, the cost of goods is going up. Oil is a physical commodity, so its price will go up too. Therefore, if I buy an oil ETF or energy stocks, my portfolio is protected from the ravages of inflation. It acts as a cushion.
Treating oil as a defensive cushion is like noticing your house is getting a little warm and deciding to cool it down by throwing a lit match into the living room.
Wow. Okay.
Oil does not absorb macroeconomic shocks. It actively accelerates them. It is not a hedge. It is a systemic destabilizer.
Break that down for me. Why is oil fundamentally different from buying a basket of agricultural commodities or industrial metals?
Because energy is the foundational input cost for the entire global economy. It is the base layer of the supply chain.
You literally can't do anything without it.
You cannot mine copper without diesel fuel for the excavators. You cannot harvest wheat without fertilizer, which is derived from natural gas and oil. You cannot transport a single consumer good across the ocean without burning petroleum.
So a spike in oil doesn't just stay isolated in the energy sector. It immediately bleeds into every single line item in the economy.
It permeates everything. When oil prices spike, whether due to an OPEC production cut, a geopolitical conflict, or just a localized supply shock, it instantly translates into higher headline inflation.
The cost of manufacturing jumps.
The cost of logistics jumps, and eventually the cost of all consumer goods jumps.
And this is exactly where the central banks get dragged into the fight.
They have no choice. Central banks operate under mandates primarily focused on price stability. The Federal Reserve, the ECB, the Bank of England, they monitor core inflation metrics very closely.
But they usually try to strip out food and energy, right?
They do try to look at the core trend, yes.
Mm-hmm.
But a sustained oil shock eventually bleeds into core inflation because companies are forced to pass those higher energy costs onto consumers to protect their profit margins.
They can't just eat the cost forever.
Exactly. So the central bank looks at the dashboard, sees the inflation dials flashing bright red, and they have to react. They can't just sit there and hope the oil price comes down magically.
They are forced to tighten monetary policy.
They must raise nominal interest rates. Or In a 2026 context where rates are already elevated, they must commit to holding those rates in restrictive territory for a much longer duration than the market was pricing in.
And this is the domino effect, because the moment the central bank tightens policy, they start draining the lifeblood out of the financial system. Let's trace these dominoes carefully.
The transmission mechanism is absolutely brutal. The central bank raises the cost of capital, immediately financial conditions tighten.
Mortgage rates go up.
Mortgage rates go up, which cools the housing market. Corporate borrowing costs go up, which forces companies to halt expansion plans, cut capital expenditures, and eventually reduce headcount.
That's demand destruction.
Precisely engineered demand destruction. By raising interest rates, the central bank is actively trying to slow down the economy to kill the inflationary pressure that the oil spike initiated.
Wow.
As economic growth compresses, liquidity is rapidly drained from the financial system. Credit creation slows. Cash becomes scarce and expensive.
Okay, let me interject here, though, and play devil's advocate for the legacy playbook.
Go for it.
If I am an investor, and I know that an oil spike is going to cause inflation, which will force the Fed to hike rates, which will slow down the economy, why wouldn't I just buy oil?
Well,
I mean, even if the rest of the world burns, my oil position's going up, right?
Yeah.
I'm catching the initial price spike. Doesn't it still function as a shield for my personal P&L?
it functions as a shield only if you view your oil position in a complete vacuum, completely isolated from the rest of your portfolio and the broader liquidity environment.
But I don't just own oil.
Exactly. The reality is vastly more destructive. By buying oil as an inflation hedge, you are essentially holding the pin to the grenade that is blowing up the rest of the macroeconomic room.
Because my oil gains are getting dwarfed by the collateral damage everywhere else.
Exactly the issue. Let's look at your holistic portfolio. You bought oil and it went up 15%. Great. But remember the dominoes. The oil spike forced the Fed to hike rates.
Right.
Because rates went up, the bond market sold off, so your fixed income portfolio is bleeding. The higher cost of capital crushed corporate earnings expectations, so your equity portfolio is down 10%. Mortgage rates spiked, so your real estate investment trust is plummeting.
And what about my gold?
Oh, the massive tightening of financial conditions, the draining of liquidity, and the rising real yields have created the perfect environment for the U.S. dollar to surge.
The left side of the smile.
Yes.
Yeah.
The strengthening dollar and the rising real yields are exerting immense downward pressure on your gold position. So your quote-unquote safe haven gold is dropping, your stocks are dropping, your bonds are dropping.
So the oil price didn't shield me at all.
No, it was the catalyst that triggered the systemic contraction that is currently wiping out your net worth.
That is a staggering mental shift. Moving oil from the defensive cushion category into the systemic destabilizer category changes how you view every single headline coming out of the energy sector.
It has to change how you view it.
But what about the reverse? The old playbook says that if rising oil prices are bad because they cause inflation and rate hikes, then falling oil prices must be incredibly bullish.
Ah, the massive tax cut narrative.
Right, it's always framed as a massive tax cut for the global consumer. Cheap gas means more discretionary income. People go shopping.
In a stable, structurally sound economic environment, falling energy prices can act as a consumer stimulus. But in the fragile, high-rate environment of 2026, a falling oil price is rarely a signal of safety.
Why not?
You must always ask the underlying question, why is the price dropping?
It's usually not because we magically found 3 new oceans of crude oil overnight.
Supply gluts happen, but they are rare. A sustained, aggressive drop in oil prices is almost always a symptom of severe demand destruction.
It means the Fed's rate hikes worked.
They work too well. Factories in Asia are slowing production. Global shipping volume is contracting. The U.S. consumer has exhausted their credit lines and stopped traveling.
The economy is literally choking.
The economic engine is seizing up. The demand for energy plummets because economic activity is grinding to a halt. In that context, seeing oil drop from $90 to $60 a barrel is not a bullish tax cut.
It's a warning.
It is a blaring alarm bell signaling that a global recession is imminent. The falling price is revealing the underlying stress in the system.
So oil offers zero shelter on the way up because it forces central banks to destroy liquidity, and it offers zero comfort on the way down because it signals that the economy is already dying.
The operational takeaway for 2026 is that oil forces repositioning. It is a catalyst that alters the structural environment. It dictates the behavior of central banks,
Which in turn dictates the flow of liquidity.
which ultimately dictates the pricing of every other asset on the board. You do not buy oil to hide. You monitor oil to understand when the regime is about to change.
Okay, this deconstruction has been absolute carnage for the traditional playbook. We've established that gold is deeply conflicted, trapped between geopolitical fear and the gravitational pull of rising real yields.
Yep.
We've mapped out how the U.S. dollar isn't just a currency, but the mandatory clearinghouse for global panic. And we've redefined oil from an inflation hedge to a monetary wrecking ball. The legacy labels are dead.
They are worse than dead. They're actively dangerous because they provide a false sense of security.
So we have diagnosed the disease, now we need the cure. How does a market participant actually survive in this environment?
We have to throw away the static labels and adopt an entirely new mental model.
Let's do it. We need to transition into the masterclass portion of our deep dive,
Yeah.
building the regime-based framework.
The transition begins with changing the questions we ask. Once you internalize that safety is conditional, you stop asking, is gold a safe haven or are bonds a good hedge?
Those are the wrong questions.
Exactly.
So what is the correct question?
The only analytically useful question in 2026 is, what specific macroeconomic regime are we currently operating within, and how does the underlying plumbing dictate asset behavior within that regime?
We have to become structural meteorologists. We need to map the environment before we decide which tools to deploy.
I love that. Yeah.
And the framework we're exploring rests on three foundational pillars. If you can accurately map these three pillars, you can navigate the 2026 market. Let's spend some significant time detailing these, because this is the bedrock of the new playbook. Let's start with pillar number 1, liquidity.
Liquidity is the absolute lifeblood of the global financial system. It is the aggregate volume of cash, credit, and central bank reserves actively circulating through the economy.
Okay, so what's the variable we need to track?
The fundamental binary you must determine is whether liquidity is expanding or contracting.
How does an investor actually measure that in real time, though? We aren't just looking at the stock market going up or down.
You look at the mechanical plumbing. You track the size of central bank balance sheets. Are they buying assets and injecting reserves, or are they letting bonds roll off and destroying reserves?
So quantitative easing versus quantitative tightening.
Exactly. You monitor the growth of the M2 money supply. You look at reverse repo facilities and commercial bank credit creation. When liquidity is expanding, when the monetary spigots are open, it acts as a rising tide that lifts all risk assets.
Capital is abundant, credit is cheap, and the financial system is flush with cash.
And in that environment of expanding liquidity, the opportunity cost of holding non-yielding assets drops dramatically.
Because fiat currency is being actively debased through expansion, so capital aggressively seeks alternatives.
Spot on. Expanding liquidity is the fertile soil required for gold to act as a store of value. It is the environment where speculative assets, emerging markets, and high-beta tech stocks thrive.
But the tide goes out too. And when liquidity is contracting, as central banks engage in quantitative tightening,
The entire ecosystem inverts. When central banks pull money out of the system, cash goes from being abundant trash to an incredibly scarce, valuable commodity.
and when cash is scarce, the dollar smile activates.
Yes, contracting liquidity is structurally toxic for non-yielding assets like gold, and it is devastating for highly leveraged risk assets. It heavily favors cash equivalents, short-duration sovereign debt, and overwhelmingly favors the U.S. dollar.
If you misdiagnose the liquidity pillar, your entire portfolio allocation will be backwards.
You'll be swimming against a riptide.
That makes perfect sense. So pillar number 2 is real interest rates. We touched on this during the gold discussion, but let's formalize how it fits into the broader regime matrix.
Real interest rates dictate the true cost of capital across the global economy. As we discussed, it is the nominal yield adjusted for inflation.
And the question we ask here is,
You have to ask, are real rates actively falling or are they rising? If real rates are falling, perhaps because inflation is accelerating faster than the central bank is raising rates, or because the central bank is aggressively cutting rates to stimulate a dead economy, the penalty for holding cash is severe.
your purchasing power is melting.
So capital flees the melting ice cube. It moves into hard assets, commodities, and equities. Falling real rates act as a massive tailwind for gold.
Conversely, if real rates are rising, which is the defining characteristic of a central bank, actively fighting entrenched inflation by hiking nominal rates.
It creates an immense gravitational pull downward on all asset valuations. The cost of borrowing skyrockets, corporate margins compress, and the opportunity cost of holding zero-yield assets becomes completely indefensible for institutional capital.
So rising real rates are the ultimate kryptonite for gold and speculative growth stocks.
Absolutely.
Okay, so we have liquidity expanding versus contracting, and real rates falling versus rising. The third and final pillar is growth dynamics.
The trajectory of global economic growth dictates the aggregate risk appetite of the market. We must determine if growth is stable and accelerating, or weak, fragmented, and unstable.
Why is growth the final piece of the puzzle, though? Doesn't liquidity drive everything?
Liquidity provides the fuel, but growth provides the confidence. In a stable, expanding economic environment, corporate earnings are rising, unemployment is low, and investors feel secure.
They are willing to extend out the risk curve.
Yes, they will sell safe haven assets and buy emerging market equities, industrial commodities, and high-yield corporate bonds.
But when growth fractures,
When macroeconomic data starts missing expectations, when purchasing managers' indices contract, when GDP forecasts are revised downward, and when corporate defaults rise, fear takes over.
and we know exactly where capital goes when fear takes over in a system built on dollar-denominated debt.
It funnels directly into the structural juggernaut. Weak or unstable growth reinforces the immense demand for U.S. dollars. Market participants prioritize the return of their capital over the return on their capital.
They liquidate risk assets and hoard USD liquidity.
Exactly.
So those are the three pillars of the matrix: liquidity, real rates, and growth. By mapping these three variables, asset behavior suddenly stops looking random and starts looking entirely mechanical.
You aren't guessing what gold will do. You are observing what the liquidity and rate environment will force gold to do.
You are looking at the engine block instead of obsessing over the paint job.
Perfect analogy.
Let's put this engine to the test. Let's run a hypothetical scenario, a real-time stress test of the new playbook versus the old playbook.
Let's do it.
Imagine we wake up tomorrow morning and breaking news hits the terminal. A massive geopolitical conflict has completely shut down a major global shipping choke point. The supply of crude oil is instantly constrained. Crude spikes $20 a barrel in an hour.
Okay, major supply shock.
Under the old legacy playbook, my brain immediately screams inflation. I open page 42. I buy gold to hedge the inflation, and I buy oil equities to ride the momentum. Let's look at exactly why that instinct is going to get a trader absolutely crushed in 2026. What is the central bank doing the second they see that oil spike?
The central bank dashboard is lighting up. They see the energy spike, and they know it will immediately bleed into consumer prices. Because their mandate is price stability, and because inflation expectations are already unanchored, they are forced to react aggressively.
So they pivot.
They immediately pivot to a hawkish stance. They signal emergency rate hikes and an acceleration of quantitative tightening to kill the demand side of the economy, since they obviously cannot control the supply side of the oil shock.
Okay, so the regime instantly shifts. The monetary spigots are slammed shut. Liquidity begins to violently contract. Because they are hiking nominal rates to chase the inflation, real yields shoot straight up. The cost of capital becomes exorbitant. And because the cost of capital is skyrocketing, corporate growth expectations completely collapse. We have entered a regime of contracting liquidity, rising real rates, and highly unstable growth.
You have perfectly mapped the structural environment. Now, how do the assets mechanically behave in this specific matrix?
Well, the equity markets are crashing because growth is dead and capital is expensive. Because asset prices are falling, prime brokers start issuing margin calls. The hedge funds and the Brazilian corporations are suddenly desperate for cash to service their debt.
And they need U.S. dollars.
So the dollar absolutely violently surges. The left side of the smile is in full effect. Global demand for USD liquidity skyrockets. But what about my gold position? I bought it because inflation was going up.
And this is where the old playbook drives you off a cliff. Your gold position collapses.
It just dies.
It is crushed under the immense combined weight of skyrocketing real interest rates, which makes holding the zero-yield metal painfully expensive, and a surging U.S. dollar, which suppresses gold's fiat price.
Even though the entire event was triggered by a massive inflationary shock.
Despite the inflation signal, the inflation was the catalyst. But the monetary reaction to the inflation created an environment that was structurally toxic for gold.
Man, so I would have bought the exact top, believing I was acquiring a safe haven, only to watch it bleed out.
Meanwhile, the U.S. dollar, which the legacy playbook ignores as a long-term hedge, provided the only actual safety in the portfolio.
That completely upends the traditional financial narrative. It proves that relying on static asset labels is essentially financial suicide in this decade.
It really is.
Assuming gold is an inherent hedge or oil is a protective cushion obscures far more than it reveals. What matters is not what an asset is supposed to do according to a 50-year-old textbook. What matters is what the current macro conditions allow it to do.
The intellectual edge in the market has entirely shifted. It is no longer about prediction. Guessing what an asset will do based on a front-page headline is a fool's errand when the underlying structure is constantly shifting.
So the edge has moved entirely to interpretation.
Exactly. Interpretation. Meaning rigorously monitoring the interplay between liquidity, real rates, and growth, and aligning your capital with the dominant regime.
You must interpret the environment. Timing and regime identification are vastly more critical than asset selection.
You could identify a fundamentally incredible company or a historically reliable asset, but if you deploy capital into the wrong liquidity regime, you will experience severe drawdowns.
The exact same asset can serve as an impregnable defensive shield in a regime of falling real rates and be completely eviscerated in a regime of contracting liquidity.
Because safety is conditional, it is not permanent.
Safety is an emergent property. It does not exist in a vacuum. It only manifests when the underlying macroeconomic architecture supports it.
Recognizing those conditions, monitoring the plumbing, and actively adapting your framework as the central bank alters the flow of liquidity that is the only mechanism that separates those who blindly follow outdated narratives from those who actually survive structural market shifts.
That completely changes the lens through which we view the market. We have dismantled the 2026 playbook and exposed the incredibly complex wiring operating just beneath the surface.
The weather has changed and the old umbrellas are broken.
As we wrap up this deep dive, I want to leave you, the listener, with a broader thought to mull over. We have spent the last hour proving that financial safety is merely an illusion, an emergent property that only exists when the structural macro conditions actively allow it to exist.
Right.
So, step outside of your portfolio for a moment. Ask yourself, if the oldest, most mathematically trusted financial rules in the world are actually just conditional outcomes, what other permanent protections in your life, your business strategy, or your worldview are you blindly relying on, simply because you haven't noticed that the foundational structure beneath them has already shifted?
It forces a necessary audit of every assumption we hold. The market is incredibly efficient at punishing those who refuse to check the foundation.
It certainly is. Thank you for walking through this complex architecture today and helping us view the market through a much clearer structural lens. Until next time, keep digging beneath the surface and stop trusting the static labels.